All right, excellent. We've created a fixed asset roll forward and a financial liability schedule. In this lesson, we'll deal with the last detailed forecast we have to create, an equity schedule. First, let's open the P&L sheet. We've arrived at EBT, so the only unknown before calculating net income are taxes. Let's hypothesize a tax rate of 35%. I'll multiply this figure by EBT, and we'll obtain the forecast for the firm's taxes in the next 5 years, which ultimately completed our income statement. Great! Let's copy the fixed asset roll forward sheet one more time. I'll rename the sheet Equity Schedule. And we'll delete all numbers. Perfect. The table we have here will contain 5 rows. Beginning equity, increase of capital, net income or loss, dividends, and ending equity. These are the possible equity movements we can have. We start with a certain level of equity, which can be measured in 2 ways. The first involves the firm's owners, who can decide to increase its capital. Typically, this is fresh money coming in and increasing equity. Another way to increase equity is by producing profits. If net income is positive, a firm's equity will increase. However, if the company is not profitable and even loss-making, its equity will decrease. Both scenarios are possible. And finally, equity can decrease if a firm's management distributes dividends to its shareholders. Let's start filling in the table. We don't need a detailed breakdown of the first 3 years. However, I will link to the ending value of equity in 2016. We can find it in the balance sheet. This value will also be the beginning value of equity for 2017. And the beginning value of equity is equal to the ending amount observed in the previous year. So let's copy this cell to the right. We can also indicate that no increases of capital are expected during the forecast period. The net income or loss that the firm produces can be found in the income statement. I need to link these cells to that sheet. And finally, we must build an assumption about the dividends the firm will distribute to its shareholders. Let's assume it will pay them 40% of net income. So I must add this new row below the table and write down that the firm is expected to distribute 40% of its profits as dividends. We need to use an if function, though. The firm will not distribute dividends if it starts producing losses. Right. Please note we have a negative sign here. I'll multiply 40% by net income figures, and this will give me the dividends that will be paid to shareholders. Perfect! This completes our equity schedule. Let's add these values to the balance sheet. The last component we need is cash. We'll need to build a cash flow statement to calculate cash.